Okay, in this video, we're going to take a look at the section of this cash flow that pertains to buying some assets and how it is we can take some depreciation expenses for those assets and what that exactly means. It's not a very difficult process, but once again, we're going to look at the same revenues that we had before and, of course, the cash expenses that we discussed earlier, and now we're down to the assets that we purchased. So let's assume for a moment that we bought a nylon string guitar to help our fingers not hurt so bad during maybe the second half of a gig. We bought a new QSC speaker because our audiences are getting bigger. And we bought a new sound seat, which is just basically a seat for guitarists. It's really high quality and I love them. So you see that all that adds up to $3,850 and that we have an allowable deduction of $3,850. Okay, so what's that all about? Earlier I talked about deductible expenses being those items that we purchase that don't retain value after the tax year period that we're dealing with. Something like renting a tent for a tailgate concert in September doesn't have any more value on December 31st, so that expenditure is a deductible expense. And then we talked about buying an asset that does have value beyond December 31st, like a guitar or a speaker or a sound seat. So, how do people actually write off asset purchases? You hear about it all the time. Someone bought a vehicle or they bought some equipment and they were able to write it off. The concept is based on the fact that, yeah, that guitar would have some value after December 31st, but maybe has a little bit less value to it. I mean, we're gradually wearing it out, and anyone could agree that the guitar wouldn't last forever. So the IRS recognizes this and allows you to deduct the potential depreciation of that asset on your taxes. And for most items, they will let you do it all at once during the year that you actually bought the asset. Now, some items like vans or a building that you may have purchased might be forced to deduct some percentage of that depreciation each year over some number of years, maybe, 4 or 5 years. And that's what the IRS calls a depreciation schedule. But most assets that you buy can be depreciated all at once in the first year. So you see here, the depreciation listed is exactly the amount of money we spent on assets. So there's one other thing you need to know about depreciation expense. Depreciation expenses are not allowed to create a business loss. So let's pretend for a moment that maybe we bought $50,000 worth of equipment, or maybe we financed something that was, $50,000. Well, you can see that 50 grand is higher than the 34,000 that we've made in profit. So therefore, we could only deduct $34,000 worth of that depreciation expense, and then whatever the remaining was, like $15,000, could be deducted the next tax period. That concept is called carrying over an expense. And depreciation expenses are allowed to be carried over to the next years if they cause a loss in the current year. And here, of course, we don't need to carry over. We're going to use it all in the current year. In the next video, I'll talk about the home office deduction and how to calculate that.